Namaste, hello, and welcome to India Global Week 2020. Be the revival, India and a better world. I'm your host, Priyanka Deo, reporting live from New Delhi. And just in this morning, we have registered attendees from 50 different countries. So this is really India's global conference. Now, with that being said, follow us on India in Corp throughout India Global Week. Let's get started with the next session. In addition to building strong India-Singapore relations, it's also as important to explore how India and Singapore can shape the future of the financial industry in Asia. Some things to consider are the impacts of and coming out of COVID-19, how finance may present solutions to address the contrasting needs of the region's markets, sustainable finance, trade finance, FinTech, and the role of blockchain and emerging technologies. Now, that's a loaded few sentences right there. So let's dive right into our session to explore more, because I'm sure our experts will be able to explain it better than I can. Next session is called Best in Class, Finance and Innovation for Global Solutions. If you're taking screenshots, posting on social media, be sure to use our hashtag #BeTheRevival. If you have questions, if you have any thoughts, I'm tracking them right here. Use the hashtag and post your question up. That being said, I am going to give it to the moderator for this session, Ms. Babita Ambekar, Partner and Head of India Practice at DWF, to begin this session. Ms. Ambekar, the floor is yours.
Thank you, Priyanka, and welcome to everyone to our session on the future of finance in Asia. Now, I'm very privileged to be joined by three fantastic panelists today. Piyush Gupta, who you will have just heard, CEO of DBS Bank, headquartered in Singapore. And secondly, Neil Parekh, who has recently taken up the position of partner and head of Asia Pacific for Tikehau Capital. Previously was the general manager of Asia for National Australia Bank. And Anju Patwardhan, who is an experienced banker, venture investor, and board director, and was previously the managing director at CreditEase FinTech Venture Capital Fund and based in San Francisco until recently. Thank you to my panelists and thank you to all the attendees for joining us today. Now, look, a key theme that came out of the preparatory thinking for this session for us was really the pivotal role that Singapore plays in the wider Southeast Asian dynamic. And for that reason, we decided that we wanted to address a number of the topics that impact Singapore and Asia more widely. Firstly, I must address the current day and significant impact of COVID-19 globally. Look, finance is such a critical element in the revival of the global world order. My first question to our panelists is, what role will finance play in the post-COVID world? And I'd be grateful for some initial perspectives from both Neil and Piyush on this. Firstly, Neil, would you like to share some thoughts on it?
Sure, Babita. First of all, thank you for having me, and India Inc. for having me in such august company. Finance has and will continue to play a significant role in the global economy and the regional economy. So, but the way I see it, in my view, what COVID-19 has done is clearly accelerated the digitization that was planned for over the next few years, and probably in a short period of time, we have accomplished, or we're hoping to accomplish, what perhaps 6 months ago we thought would take a few years. So with that comes the ability to move and offer services to corporate, retail, SME customers in a far more user-friendly fashion. Finance will continue to play a bigger role in the greater economy. You've seen the liquidity that the central banks have pumped in. So if you look at it from a macroeconomic standpoint, it's been astounding at how many people went from calling it a deep depression, perhaps in the middle of March, to now a large number of people looking for a V-shaped recovery, largely drawing inference from the markets, which again have been inspired by the tremendous liquidity that has been put in. So finance will remain important, and I'll hand it to Piyush.
Well, Babita, again, let me echo those words of thanks. It's a real pleasure to be able to talk on this panel. Let me first echo what Neil said. I think it's quite clear that there has been a massive demand destruction And there will continue to be massive demand destruction, which substantially increased levels of unemployment around the world. Now, one of the lessons which we learned, not just from the 1930s, but from the 08-09 playbook, was when you have such a big shock to the system, following easy monetary policies and flooding the market with money is actually quite helpful. It puts a floor under collapsing markets. And to that extent, all central banks around the world have followed this playbook. It has bought us time. It has helped to actually create stability in financial markets. And this is extremely crucial to be able to allow for the recovery of countries and markets in the future. I think Neil also rightly pointed out that the monetary stimulus has been accompanied by massive amounts of debt financing. The total fiscal deficits created are $12 to $15 trillion. Now, that's a mind-bogglingly large number. To a large extent, many of these are going to be monetized on the balance sheets of the central banks. People often call it modern monetary theory. Again, in my own mind, this is a good thing. It has bought us time. It's been money in the pockets of the poor. It's allowed SMEs to keep going and keep jobs going. And all of these things are extremely helpful in the short order. The real challenge is going to be next year. When I say next year, maybe later this year, next year. And the challenge is going to be simply this, that many of the companies and much of the real sector will wind up not just with a liquidity problem, but with a solvency problem. There are fundamental changes in business models that will have to be achieved. Now, what that means is that the second shoe on the financial system has to drop, and it will drop next year. I think you'll see larger amounts of delinquencies, you will see larger amounts of defaults, and therefore it will be up to the financial system to be able to negotiate that and do it in a way that you don't wind up hindering and hampering the restructuring of economies, while recognizing that it would be foolhardy for the financial sector to create a crisis on the back of a real sector crisis. So this is a challenge that finance must address in a post-COVID world. Looking at it more positively, though, I think the COVID and the after effects we're seeing give us the opportunity to reimagine the kind of world we want to create. I mentioned just now in my keynote speech that the intent and agenda of trying to create a more sustainable world, a more sustainable ecosystem, and therefore more sustainable financing, climate issues, nature-based issues, I think these are all on the table, and finance has a real role to play in shaping and building and being able to try and address this. In the past, we've often said these are tail risks, and so people have tended to push them on the back burner. What the COVID has taught us is tail risks occur, and it would be sensible for all of us to start thinking today about how we want to build a system that is more resilient and more viable in this new kind of world that we want to create.
Yeah, absolutely. Yeah, there's a lot to think about, and finance's role is critical in this dimension. Okay, something we had been discussing when we were doing the initial thinking about this session, Anju, and I'd like to get your thoughts on this. But we had been considering that the COVID impact will actually cause potentially a whole new range of people to fall within the definition of the needy. So I would like to understand how the COVID effect, what that will really have as an effect for the definition of inclusion in the region.
Thank you, Babita. Let me first start by echoing what my co-panelists said. It's a great pleasure to be here, and I think we have some very interesting things to say about the future of finance and about financial inclusion. In the past, the conversation on financially underserved or financial inclusion has often been dealt with as something which impacts lower income people, as if it's an emerging markets problem. And I think it's time for us to move the conversation beyond financial inclusion to financial well-being and financial resilience. Inclusion is just a means to an end. It's an ability to open bank accounts, but what do you do with that to build resilience in the population is the critical thing. And if we look at some of the data pre-COVID, even before COVID. For example, in the United States, the US Fed does an annual survey, and in the survey, they, last year in October, when they asked people about their ability to manage financial emergencies, one of the questions was if people could generate $400 for an emergency without borrowing or selling something. And the answer was indeed, shocking to some extent, where 37% of the people said they could not. Right, that's 1 in every 3 people that you meet who did not have $400 in savings to deal with any emergency. And this was pre-COVID, right? This was before the scenario where 45 million people as of June have filed for unemployment benefits. Half the adults are looking for jobs. And the situation is not just specific to the US. It's a similar scenario in other emerging markets, in other developed countries, and probably even worse for small businesses and micro enterprises. So I would say that this whole financial insecurity issue, in a very sort of adverse way, has got democratized. It's no longer a lower income problem in emerging markets. It's also impacting the middle class. It's also impacting people in developed countries. And therefore, the conversation needs to move beyond inclusion to saying, okay, in the post-COVID world, what should the financial sector do? Or even at a broader level, at a government level, what should be done to build resilience in the population and enhance financial well-being? Most people, even before COVID, said they had only less than 3 months of savings. And this, in this scenario, it's going to become a much bigger number.
Thank you for your views on that. Okay, look, we've just spoken about the huge divide within society that is largely to get greater. And within Asia, it's further complicated because of a strong contrast between the mature and emerging markets within Asia. So my next question is, how can finance present solutions to address the contrasting needs of this region, which are very unique to this region? And on this question, I would like to go to Neil first.
Thanks, Babita. I think what Anju mentioned also is relevant here in terms of the number of people that will need help in the years to come has just become a lot bigger. Now, broadly speaking, all of us know we talk about Asia, but they're really, each country is unique. We don't have the time to go country by country here, but we can certainly distinguish between emerging Asia and perhaps a little more developed Asia and some of the issues faced in each semi-region. So in emerging Asia, I think the demand for credit is going to be paramount, and the demand for microinsurance, insurance in any form, but microinsurance is going to be critical. And, the problems that were faced earlier, say in a country like Indonesia, in the region, have been accentuated, has just become much larger based on what we've seen in the last few months. Now, in terms of solutions, I think a lot of the solutions involve technology, and that's the only way around it, because it's just not easy in a physical form to reach multiple customers in remote regions of different countries. So FinTech, working with financial intermediaries, is really the way to go in my view, and that's where the solutions are. Greater information flow is another place to be. I'm a big fan of something that the MAS and IMDA put together recently, which is called Business Sans Borders. And it's really a major project which has really brought together a number of contributors in logistics, in finance, in business service providers. So if you have, for example, someone wanting to sell widgets in Jaipur and there's a buyer in Bangkok, it's far easier through the system to actually link everybody together. It's more regional than perhaps statewide. So to me, the solution for developing economies involves extensive use of technology and digitization, not just in finance, broadly speaking. When we look at more developed economies and what is the need of the hour, and I think the real need is really customized, bespoke solutions for businesses, for individuals. And I know we're going to be talking about sustainable finance, but if someone has a priority to do something in that sphere, is an institution able to create a customized solution for them? And I don't want to jump the gun and talk about sustainable finance here, but I think broadly speaking, the need of the hour is more bespoke solutions, customized solutions, being fully aware of what people want, and using artificial intelligence, using the ability to gather data rapidly as well as analyze data rapidly and put that to work. And I think there's a lot of work to be done in both areas as we speak.
Yeah, absolutely. And we'll be talking more about technology in the next couple of questions actually as well. So we'd love your input on those as well. Anju, would you like to add any further comments?
Just a couple of quick thoughts. Even before COVID situation, there were some differences in the way FinTech was developing in Asia versus rest of the world. And I would say that when it comes to B2C FinTech, consumer-facing companies and services, Asia is probably quite a bit ahead of some of the other geographies, particularly China and India. The approaches are different. But the coordinated effort between banks, between governments, and the technology companies is quite a game changer in this part of the world. Piyush briefly referred to the national payment rails in India and in Singapore, and now the intention to make this cross-border. You don't see that kind of coordination in the US, for example. There are too many regulators. It's quite fragmented between the federal regulations and state regulations. It's hard to make some of these changes in the Western world. On the other hand, I would say that when it comes to B2B FinTech and the overall infrastructure, it's really fascinating to see some of the companies that have been coming up in the US and UK over the last few years, particularly when it comes to payments for small and medium enterprises or corporate payments, supply chain financing, or even infrastructure when it comes to high quality synchronous videos, which are now becoming more and more essential to support large scale conferences or large-scale online classes or future of education. So I think what's going to happen with COVID is that we are going to see a significant acceleration in all things digital. Earlier, people were on this digital journey, but it was a step function. It was kind of slow progress, and now everyone was forced into making everything digital, not just the consumer-facing aspects, but literally everything, and the way we work, the way we learn, the way we play. And I think that is going to continue.
And there are a whole host of things associated with making finance digital, which I think is probably the subject of another webinar entirely, but we'll leave that for today. Well, look, thank you.
Actually,
thank you,
Babita, if I can come in, I thought I'd make a couple of comments. One is on, Anju mentioned this need for finance to address this problem of financial wellness and security. And I'm sympathetic to the idea. But I also believe it's not appropriate to put that monkey on the back of the financial system alone. What the financial system can do is help create convenience, help create products, and help create services to make it easy for people to save, invest, or borrow. However, the problem of not being able to have security of $400 or $200 is not something the financial system will resolve. This has to be a social government effort. If you think about why do you have a social security system in some countries? Why do you have unemployment benefits in some countries? Why do you have the New Deal post-1930s in the US? These were government measures and nothing to do really with the financial system. And this goes to more fundamental things. What is your capacity as a country to be able to create such social security programs? What is the capacity as a country to reimagine and create new employment generation? And it would be unrealistic to expect the financial system to be the avenue by which you're going to solve all of these really important questions and existential challenges. So I just thought I'd make that point. The second point I thought I'd make is that while I agree with the notion that the state of developed and developing markets or emerging and emerged Asia is different, I tend to think about it in a different prism. And that is, Fundamentally, what financial systems solve for is very similar across all countries. We solve for the need for people to save. We solve for a need for people to be able to invest. We solve for a need for people to be able to borrow. And we solve for a need for people to be able to pay. Those fundamentals don't change very much. That's exactly what somebody in the US or UK or Singapore wants to do. And that's exactly what somebody in Indochina, Indonesia, or India wants to do vis-a-vis the financial system. So what changes is the infrastructural arrangements and the size, ticket sizes, and the prioritization. So if you think about savings, if you're in a rich country, savings tools and savings focus tends to be somewhat different. The larger ticket sizes, people have more established saving schemes. If you're in a less developed country, if you have large unemployment, huge migrant populations like in India, you've got to cater for a different set of products which allow micro savings, which allow the capacity to you to use mobile phones a lot more easily because you have access to the physical bank system. So you need to be more creative about the kind of saving solutions and products you create, which cater to the bottom of the pyramid, for example. Similarly, borrowing. If you're in most rich countries, there's access to bureau data and there's access to credit history. But in most less developed markets and emerging countries, you often find the bureau data and credit history is lacking. And therefore, large numbers of people are unable to actually gain access to credit. So you need to be more creative about how do you credit qualify people, which means how do you use data differently? How do you use alternative forms of data? How can you actually create credit models which go beyond credit bureaus? So the way you handle it has to be different. Your creativity has to be different. The approach has to be different. But the fundamentals of what you're trying to solve for, it seems to me, are quite similar.
Yes, absolutely. Yeah, I completely agree with that. Yes, exactly. I mean, what you're seeking, what people are seeking remains the same. It's the delivery that needs to be adapted depending on the market. Yeah. Okay, well, moving on to back to a more global theme, I guess, now. Piyush, I think you touched upon this in your address. Unfortunately, I wasn't able to hear the whole of that, but Anju kind of shared it with us while we were waiting in the back room. But look, I'd like to kind of consider some of the more emerging and topical developments in finance. For example, the importance of sustainable finance, the push for increased transparency, and the utilization of new technologies such as blockchain to build apparently trustless finance processes. So I wanted to understand to what extent it is your view that sustainable finance is a regulatory imperative, and to what extent you think that emerging technologies can play a role in increasing transparency in finance.
First off, Babita, I'm not sure what you mean by trustless finance. I hope finance is trusted and not trustless. It would be helpful.
You don't need to validate.
All right. Okay, but I think from a regulatory agenda, I think sustainable finance is going to be hugely important for a couple of reasons. The first reason most regulators are already engaged on, and which is a recognition that there is a lot of risk today built into the financial architecture. The risk comes from, for example, if you think about climate and climate change, there's a real risk which comes A from physical risk, and B, a risk that comes from transition risk. What does that mean? Today, we are doing financing in all low-lying lands and low-lying countries. I'm in Singapore, we have a large mortgage book. If temperature levels go up a couple of degrees, water levels go up 3 meters, 1/3 of Singapore will be underwater. Now, what does that mean for us as banks? How should we be thinking about the risk built into our portfolios when that happens? Let me give you another example. If you think about all of the large financing we're doing of renewable assets, if you wind up in a world where renewable assets are no longer kosher and people all wind to new renewable forms of energy, what do you do with the stranded assets which are left? You financed, coal mines and you financed the power plants for 20, 30, 40 years, and now there's no offtake and no demand. So the reality is that there is a lot of physical risk built into our portfolios. There is also a lot of transition risk because most countries are increasingly putting in rules which say you have to transition to a net carbon neutral world or a 2-degree world, and therefore the following laws will apply. For example, carbon tax will kick into place in most markets. Now, if your clients are suddenly going to have to pay carbon tax, that will impact the EBITDAs, and that will impact, therefore, the viability of your loans. Now, that's a transition risk. Therefore, I think the regulatory imperative for most banks and financial companies to model these risks and be able to account for these risks in their capital thinking as well as in their risk measures, that is already on us. And in the next 2 or 3 years, that will be a regulatory imperative without a doubt. The second reason you'll start seeing a regulatory imperative is social pressure. It's quite clear that investors, civil society at large, are increasingly raising the bar on how they want the financial system to be able to respond and react. And on the back of that, therefore, you're going to find regulators who will insist on a lot of disclosures. That is already happening. The TCFD, the Task Force on Climate-Related Financial Disclosures, has had a lot of currency in the last 2-3 years. Mark Carney from Bank of England has been pushing the agenda. And most countries now do have a requirement for TCFD disclosure, Scope 1, Scope 2, Scope 3. These are primitive. There are a lot of challenges with them, but they will continue to get better. And frankly, technology will help. The capacity to track, trace, and verify will help to make this better. But I think you'll start seeing a lot more disclosure-based stuff. And the minute you start seeing disclosure-based activity, you'll then move on to more forms of impact-weighted accounting. So I think this idea of purpose is going to create a lot of currency, including with the regulators. What is your agenda with respect to community at large, and therefore with not just the environment, but with social metrics and governance metrics? And therefore, this idea of impact-weighted accounting, how do you impact for not just physical, real money capital, but natural capital, human capital, social capital, physical capital? I think you're going to get to a world where people are going to ask you to start accounting for these different forms of capital as well. So I think over the next few years, all of these are going to be front and center of the regulatory agenda. Now, the reality is what you alluded to is true. In the old world, one of our big challenges was it was very hard to do these things because the analog world and the old ways of operating did not make it easy. There's a massive overhead if you wanted to try and measure some of this stuff. But new technologies let you do that far more sensibly. So using sensor-based technologies, using GPS technologies, using Internet of Things as you go forward, and using blockchain, you can do much better jobs of capturing what is your carbon footprint, what is the nature of the soil, what is the atmospheric conditions, what is the provenance and transparency of this of your supply chain. You can build solutions leveraging technologies which are a lot more cost-effective and a lot more scalable. And therefore, the fact that it will be a requirement will be married on the other side with a set of tools which will make it a lot more easy and efficient to be able to achieve this. So I do think that these two paths are coming together. In the next few years, this will be quite high on the agenda of most banks and financial institutions.
Thank you. Neil, is there something you'd like to share on this subject?
I'll echo a lot of stuff that Piyush has mentioned. What I would like to add here is really from a FinTech, and I know we are going to be talking a little bit more on that. You know, the ability to use technology to accomplish a lot of these things. For example, simple things like RegTech historically has been used only for KYC, AML, so know your customer, anti-money laundering processes. But increasingly so, now you have checks and balances being put in place as there is greater demand for sustainable finance to make sure that actually things are being put, controls are in place, and the regulators are informed in the right fashion. Green bonds obviously have been around, and a few have been issued with more to come. And I just feel, going back to the point I made about customized solutions, and I just want to tie that in with sustainable finance. Increasingly in developed economies, one of the delivery mechanisms that is needed is to really find solutions that meet the needs of investors as well as institutions. And now with technology, one can really find sustainable finance, green solutions. And I think that is really a trend for the immediate future.
Thank you. Well, fantastic. Look, we've touched upon it already because it's such a key feature of the future. But you know, we couldn't run this panel without a focus on some of the leaps and bounds of the fintech industry and the possibilities that it generates for the finance sector overall. So I would like to now ask Anju, being in the fintech industry, in the sector for many years, what is your perspective on the likely evolution of the industry in South and Southeast Asia? And are there any global comparatives that we can draw upon when we consider this? Anju, you're on mute.
Okay, sorry about that. Yeah, so as we mentioned briefly during the intro, our FinTech fund, we've invested in over 60 companies. And this period of last 3 months has been very interesting. Like in any other industry, there are going to be winners and losers, and the process of winning or losing is going to get accelerated. We've seen some of our companies which have raised rounds in the last 30 days of $50 million, $100 million or more, because they are benefiting a lot from this digitalization process. And then there are some which are in the lending space which are finding it quite difficult. So I think the few things that we will see as we talk about winners and losers. In the past, the conversation always used to be between fintechs and banks. And over the last few years, it's moved on from being competitors to collaborators to a point where a lot of banks think of fintech companies as vendors. But I think the portion that both banks and non-banks now need to be looking out for are the big tech companies getting into financial services. And the current situation is, again, going to result in some of them really accelerating their efforts into financial services through partnerships or direct licenses or challenger bank applications. And then there are some who are going to put their plans on the back burner, like Uber. But definitely a space to watch out for on what are the big tech companies intending to do in the financial services space. The second one where we are seeing a lot of investment and acceleration is going to be around use of artificial intelligence. But before that, RPA, robotics process automation, it doesn't sound very glamorous, but that's really where most of the banks are focused on automating the workflows. Simple things like call centers have been so badly disrupted. A lot of companies and airlines were running call centers in India or in Manila, and because of the lockdowns, there was a huge disruption. And everyone is now looking for solutions to run cloud-based or distributed call centers. And how do you manage that? How do you use video tools better to prevent some of these? And that leads us to the next point where, how do you think about future of jobs and future of work? I mean, people are already doing remote working. And I think the tools that facilitate remote working will get better and better over time. And once they get better, then does the job have to be in that city? Or does it have to be in that country? Or does it even need to be on that continent, right? So those are the conversations that will certainly come up as the ability to work remotely improves very significantly. And the last point I would say, it was briefly mentioned earlier also, there'll be a lot more focus on privacy, on identity, on security, even on use of data. And I think the conversations are starting more probably in the healthcare space. And in the fintech space, it's always been front and center on how you use consumer data. But I think more industries are going to talk about it. And we will see many people building solutions around it, solutions around digital identity and security. Last week, in fact, we read that OCBC Bank announced the ability for people to log in using SyncPass. I think that's a huge step, right, in terms of managing your credentials and linking it back to the national infrastructure point. How do you bring it all together in a secure manner, but maintain privacy? So I think we will see a lot of progress. Things will start moving faster in these areas all over the world, not just in Singapore or in Southeast Asia.
Thanks, Anju. Thanks for that perspective. Piyush, is there anything you'd like to add on this front from a bank's perspective?
Well, I've maintained for a long time that I think this idea of who will succeed and what will the makeup of the industry structure be going forward, it's got to be seen from a very simple prism. And that is what I referred to earlier. The fundamentals of what we need to do in the industry don't change. You need to save, to borrow, you need to invest, to pay. I also think that any company today can build the technologies to be able to do this in a very sophisticated, efficient kind of way. The technologies are freely available. Most of them are open source. There is nothing that Amazon could do or Google could do that any other player cannot do. In fact, Amazon and Google offer their entire technology to anybody to build their capabilities on the back of. And therefore, anybody, whether it's an incumbent bank or whether it's a newcomer, could actually leverage the technologies to build solution sets which are competitive and capable. So in my view, the industry structure will be driven principally by people who've been able to build out these solutions and capabilities at scale. Now, in that structure, it is quite clear that many incumbent banks can do quite well. The notion that all incumbent banks will lose to FinTech, I don't think is valid as a consequence. Equally, I think a lot of, I call them tech fins, the large technology companies, well, and financial Alibaba is already doing that. Google's got fantastic traction with Google Pay in India, and Facebook wants to launch Libra, so many of the big tech fin firms will do well. What is common between both of them is that they have large extant customer bases. Who will struggle generally are companies who are happy to spend a lot of money to acquire customers. They've been able to succeed in the past because they get a lot of cheap free money from venture capital and from private equity. But I think that is something that is going to change. On the back of WeWorks and Uber and the COVID and so on, I think most investors are increasingly looking for real business models, looking for a line of sight of profitability, and looking for EBITDA. And as a consequence, I think companies which are not able to demonstrate a real business model and EBITDA positive business would find it hard to survive. And for a lot of companies which don't have access to customers might not find it easy. Many of them will do what you said. They will latch on to existing providers, existing banks, and be effectively quasi-vendors of in creating capability, but might find it hard to build large independent businesses. So I think that's one big thing that I see happening as you go forward. I think some of the other things that you said are spot on. I think there's going to be a lot more focus for companies who are creating digital capability, whether it's RPA. I think big data and artificial intelligence will be big. But I also think the FinTech universe will start focusing on some of the newer technologies as well. I think augmented reality and virtual reality in this distributed world, I think you'll start seeing much bigger presence of that. I do think blockchain, not just currencies, but digitized assets, the tokenized assets, you will see a lot more active action in that area, including from incumbents and new fintechs as well, if you will.
Absolutely.
I will add one other point to that, which I think we're going to see a lot of activity on how the regulators look at fintech companies, especially in the wake of what's happened recently with Wirecard. So, it's going to be more and more of activity-based regulation as well, and not just entity-based regulation.
Yes, that is definitely going to change in view of the Wirecard situation. Well, look,
if I may add one point here. We touched on that a little briefly. By the way, I agree with a lot of the points that Anju and Piyush mentioned. Is clearly seeing a greater focus, being the investment management business now, seeing clearly a greater focus on seeing how technology, FinTech, can help. So green FinTech, which has been around but has not taken off, to me, in Singapore, is ripe for a change. So if it may be, blockchain-based green bonds, or even a customized green investment solution package from various private banks, or simple things like if I'm spending X $1,000 and I don't want KrisFlyer miles in return, but I want to actually plant trees in some parts of the world which clearly need them. The ability to do that using FinTech, I think, has become has become in vogue, but a long way to go in the near future. Just wanted to add that. I think Piyush and Anju covered a lot of it.
Thank you. Look, I mean, there's so much there that we could discuss more, but unfortunately we're out of time. Look, it's been a fantastic session. Thank you so much to my panelists for your time and your insights. Thank you to all of our attendees for listening in and being present for our session. And we look forward to the next India Global Week and participating in that. Thank you.
Thank you, Babita.
All right, bye now. Thanks very much indeed.